they were okay. The people of Sufa were under poverty, and when Abu Bakr Siddiq
Hi guys, I'm audible? Yes? Hope my screen is visible now. And we're gonna start. Apology for the delay due to some IT related some matters. But let's see. Let's start now. Before starting today, I want to just give you overview. What is our point of view to start to how we take forward this Corporatex training series. So as of now, we are discussing the topic by topic. That topic will be covered in the Corporatex. So each topic itself, we are giving the overview. As of now, we are overall structure or the base or the foundation of the Corporatex that is required while we filing the return or while we understand the Corporatex. So we are discussing the key areas or the topics that will be covered detailed training or discussion in later on each topic. But if we go standalone on one topic and have the full discussion or training or understanding, that will make us some confusion or some our understanding will not be the completed. Why? Because first we have to see what is the overall structure of the Corporatex and what are the foundation. Because as of now, we are just making the foundation or base of all of the participants. So they will be understand. Later on, when we are discussing, they will understand, okay, this topic, where it will be helpful while filing the return, or where it will be link while preparing the internal books of accounts. So this is the important point we have to understand here. I divided the parts. On each topic, I'm dividing in multiple parts. So in each part, later on, we will have a couple of sessions on each topic. So that topic will give you the better understanding of the complete application of that Corporatex relevant applicable ministerial decision or cabinet decision by keeping in mind the accounting perspective also. Because standalone, the text already available on the FTA website, Ministry of Finance website. So mostly we already gone through. But the main point that where we maybe most of us is not understanding how to apply that. So as of now, we are just preparing our base. Once our base is ready, then we will dive into detail of each topic with the example to understand further. So today I shared one example in the group. So I would like to start with the same example. I believe most of participants, they already gone through that example. So let's start this example because in last session, we already go through this topic. So just for sake of understanding, I'll just give you the overview. Okay. So the overview, we discussed the part 1 and the Corporatex registration, accounting period or year end of the company, first tax period as per city law, city return due date, city liability payment. It is the same thing in only the agenda or the title of that slides I just updated for better understanding, but everything is rest is same. So this is we discussed to understand basic concept of the Corporatex registration part or the company, because once you register, the first question will appearing, what is the company tax period or the year end? So that we discuss in detail. Then the next, what is the tax period? So we discuss accounting period and the tax period will remain same, except the natural person, their accounting period will be Gregorian calendar year, that is January to December. Now the registration Corporatex overview we have seen. Then the part 2, in which we discuss the Corporatex is payable on which income and who will pay. Okay, so that we also have the detailed understanding, because first the registration, then the next question is coming in mind, who will pay and on which income they will pay. So we have the overview discussed over here. While discussing that, we have, who will pay and on which income they will pay. If we ask who will pay, so there will be some taxable person and then some will be exempt person. So this is the who will pay, taxable person, and some have the exemption, and on which income they will pay, taxable income. So this we understand in the last session. We will not go in detail. just for overview, I'm just sharing again. Okay, now here we seen the example. The example is the most important for understanding. Okay. Now we came back to this example, and the example we are saying why we need this example up to improve our understanding. Because theoretically we can discuss, we can go through the articles, but still our understanding will not be developed 100% at the appropriate level, at the satisfactory level where we can use in our practical life, in our profession. So here today we are discussing the example, this natural person versus real estate companies. Because for natural person, there is some exemption on real estate. So we have to understand what is the relief part for natural person and what is not the same relief is not available when the same natural person operate that activity through the trade license. Just let me take the laser pointer. So here the natural person, they have some relief on the real estate. As earlier we discussed, the natural person will not pay the tax on their salaries and wages, personal investment and real estate income. So now we have to differentiate why the real estate having under the natural person ownership is the beneficial versus not beneficial if you have real estate company or you operate through the trade license. So we split the below example, we split the portfolio of the natural person. What does that mean? The portfolio, he have the properties and that we keep some property under his personal name and some under his real estate company. To understand the difference, this is the one of the example we taken from the FTA document, the FTA workshop. They given this example. So most of the data we took from the FTA presentation and some other FTA seminar or FTA relevant guideline. We are trying to get the data for our example or understanding. So this is the one of the comprehensive example because FTA have one specific workshop on the real estate because most of the UAE national they have the properties. They have the properties, so they are concerned to support their national as well as to bring the investment in the country on the real estate because each country they have some relaxation, some relief in certain sector. So UAE they give some relief in the real estate. Real estate as a natural person to support to bring the investment in the UAE and support the real estate sector. They have this relief. So we're gonna discuss and understand. Now here we understand that what is our example or question over here today. Mr. Y owns 7 apartments in Dubai. So his total, the portfolio is a 7 apartment. Now we will split this 7 apartment into 3 categories. The 5 he rent out as a holiday home via trade license. Now holiday home, and here they mention the via trade license. This is the very important. If they do not mention the via trade license, why they are mentioning? Because this activity, the holiday home, normally there is small, if you go online and check, there are many holiday home or application online. So they are offering you this service. So if they have the license for holiday home, so that will be come under the real estate income, under the juridical person, under the incorporated juridical person and the incorporated income. Now the second apartment, one of that he lives personally. Okay, he living is personally as a personal under his own name and he's using as a residence. The third one he rent out to individual. Now is under his ownership. The 5 he gives to the holiday home via trade license. One he's living himself, and the third one he rent out. Now he's renting out directly to the tenant. Now mostly we are expert in UAE, so we are taking the apartment from the real estate companies, and but still there is some apartment. If you take the ijari, the name is appearing of the local. the UAE resident who own the property, the ijari will be issued under his own name, not from the under the real estate company, because the real estate companies may be involved in that as the real estate management purpose, because they are not owning the property, they are facility management. Some companies who provide the services to manage the facility. To manage the facility on behalf of owner, they will deal with the tenant and collect the money, and they will give to the owners. Okay, but this is the facility management. Even that they can give to one of the person who's work for him on behalf of him and do all this process. So we might seen this example in our real life, because we are having the ijaris in each emirates where the people are living. Now the next, the income generated. Now he's separate the portfolio. Now the next he is saying the income generated from this such activities, the three activity. What is the income generated in the Gregorian calendar year? Here the important Gregorian calendar year, but here we have to see if the natural person, Gregorian calendar will be applicable if it is taxable. Although up to 1 million they have the relief, even their real estate exemption plus the 1 million relief, even you are exceeding the you are make the company as a real estate, but still your income less than 1 million, still you can take the relief for that. But mostly the UE local, they have the properties that maybe we not count, and they have million, trillion income from the real estate. So that's why they have the advantage, they keep the property under their name. Whatever the income generated from the real estate that owned by them, and they are not operating through their trade license, because there is certain activity there, trade license is not required. If the trade license is not required, this is the important part. What the FTA or the Ministry of Finance is saying, they think if you are doing some activity that do not require trade license and is under natural person, then the real estate income or that activity, mostly we are discussing here the real estate that will not subject to the tax. Okay. But if the saying, even the activity, just for understanding that this important part, even the activity you are doing, but you do not have the trade license. But as per the Department of Economic Development or the UE company commercial law, so they're required to have the trade license, but you do not have it. But still, that income is subject to corporate tax. So this is the important factor. But today here we want to understand if the person having the real estate property under his own name, is he can get the relief, or he will get the exemption from the corporate tax. But if he have the same property under via trade license and operating, that will be taxable. Let's see. He have 5 holiday home. He generate 2.1 million. One personal apartment, zero income. One rented apartment with ijari is a 90K. So these three he give the income generated from them. Then what is the expenses? So now he's saying why Mr. Y incurred mortgage expenses. Okay, so he may build or he may buy these properties against the bank finance or mortgage. So he paying the mortgage interest expense 280K. And it belongs to 7 apartment, and each of the 7 department has the same purchase cost. So what do we do? 280 divided by 7. So per apartment cost will be there. So now the whatever the income is taxable, accordingly expense will be deducted from that. So now here the solution or example for understanding we are discussing income of 2.1 million. Here we are discussing holiday home subject to corporate tax, as this income is earned under a trade license. As we earlier mentioned, this is not under his personal name. This will be subject to corporate tax. We have to pay the corporate tax. Now the second example is the personal. This is the under personal. We know there will be no corporate tax for own residence purpose. Now the third is they rented out to individual, but is under an own name with HRE, because the HRE also will be issued under the local name and the counterparty will be the tenant. Income generated is a 90K. This income is subject to real estate exclusion, real estate exemption, what the relief or the benefits to the natural person. Subject to this is not conducted or required to conduct through a trade license. He think he not conduct from the trade license and is not required to conduct through the trade license. The important point to understand is this very critical and thin layer. This is the most important for understanding. He did not conduct from the trade license, but also he is not required the trade license to conduct this activity. Okay, now the expenses, income we already seen, the expenses, he already mentioned the equity distribution over the several apartment. So Mr. Y conduct 200K because here we are saying the 280 divided by 7 multiply 5. So we are saying Mr. Y can deduct 200 because 200K belongs to this income that he generated against the 5 apartment. So the 2.1 million from the 2.1 million the income, this is the expense, it will be minus, which is subject to corporate tax, and there is no relief for the share of interest relating to the other apartment. So this we discussed. So now here is another point that is coming, the interest. Okay, the mortgage interest. This also mortgage interest capping rule that also we'll discuss in upcoming part, that is the interesting and comprehensive, because if we are paying the interest in our company to bank for bank financing and whatever the means we took the interest, we will have the detail. So there is the interest capping rule. All the interest you cannot deduct. So we have to see in the detail. So which will be deductible and which will not be deductible. So I'll move back to the today topic. So here the couple of other slides that we added for better understanding. So today our topic is a business vehicle. So we will start from our today topic. That is our primary topic for the today's session. So here we mention the date, our today, and the 19th January 2025. So let's move to our topic. Before that, I'll share one quiz link, maybe for today attendance and today understanding. So I expect from all of the participants to fill that. And parallel, we will start today. So please take quickly 5 minutes and complete this quiz also. Yes, dear participant, please confirm in the chat if you're done so we can start today. And the another point that I would like to ask again, because today we give the overview of how we are going to build the foundation, and then we will dive into detail of each topic, and we will link with the corporate tax return as well. Today I'll show you this a couple of slides that I added from the corporate tax return as well. That earlier I did one small demo and shared over the YouTube also, but I added that slide here in this session also, just for better understanding how it will be beneficial for you guys while preparing the return, because each area is important over having the overall framework, overall the understanding the base, because as of now I'm doing building the your base, building your foundation where we can build the corporatex whole structure. Standalone, if we dive into one topic, that will not be much helpful. It will not, you are not able to integrate why I'm doing and where it is required to be linked. Please confirm in chat so we can proceed. Thanks, Mr. Hamza. Okay, guys, let's move to our today topic. Today our day 2, date 19th January 2025 for the Corporatex series. So today we are discussing the part 6. Under part 6, the business vehicle. The last session we stop here, and now we are starting from here, the business vehicle. We are discussing the business vehicle for just for our understanding. We most of living people in UAE, and we having the some vehicle that we are using as a mode of transport. Mode of transport, we are traveling from one place to another place, and commonly we are going to our office and office to home and some other client meeting or some other purpose also. So our objective to the mobility that give us the option or the flexibility, we can move from one place to another place, from home to office or office to home, or to visit the client. So this is our objective. So our objective will remain same, but vehicle can be changed. Vehicle can, because maybe some people have the sedan and some people have the 4x4 or the station car. There's a many station cars, so maybe they are using that, or some people using the big vehicle. there where the family members are more, so that he needs the big vehicle to cover the objective of his family member. So by having the objective, we can take the calls, so which vehicle is suitable for us. So the concept is shared over here just for understanding from our practical example, our real life example. Now, if you apply the same example, understand why the business have different vehicle. Okay, so here the important part we are going to discuss what are the business vehicle and what are the plus and minus of having the vehicle. Because if the ownership or management or the shareholders, they must define their objective before starting the business. Accordingly, they will choose the vehicle, which vehicle mode is relevant for them. So for business vehicle, we will separate into two category for our understanding, and this is the FTA also give in the same two category, the understanding or the clarification. Now on the same parameter we are going to discuss. So most of the my understanding are the point of view to share with you guys as a part of tech series. I'm trying the way how I learned from the PwC. I am took the training from the PwC, so I'm keep aligning the way of sharing the knowledge with you guys, are trying to share the taxation training in the same pattern wherever is possible, but it's not the 100% is same, but the mode of the way of presentation and way of communicating, I'm trying to be keep the same. I'm trying they might make the presentation from different source of data wherever is possible. From mostly I tried from the FTA, like the workshops and the tax return that you will see today. The tax returns, couple of slides are there. So that I added over here for better understanding why we need this. I appreciate people do not make write on the slides. I appreciate your support in this regard. Now, our first vehicle. Our first vehicle is an unincorporated business. The unincorporated business, the category of unincorporated business, normally we understand the sole establishment. The sole establishment. What is the sole establishment? If the natural person or own the proper any company under his own name, is a owner of the company, and there is no memorandum of article. There is no because that company is not established as per the company law. The company law, UE commercial company law, that is latest is the June 2022. All the previous legislation and the latest one is this applicable, all the revision on the company law. The entity are registered, maybe the based on the previous version or based on the new version, so all the applicable legislation will be there. So if they registered the company under company law as they that will fall under the juridical person. But if they are not registered under the company law, because if you register under company law, you must have the memorandum of association, a memorandum of article, and mostly we see in one document, memorandum of association, a memorandum of article. But actually, this is a two document, but practically we mostly they combine and issued only one document. Now, this is not the LLC. This is not the juridical person. So this is the unincorporated business. Why we are saying unincorporated? Because this is not registered as per the company law. Just for a better understanding, we discuss in a way to this is unincorporated means the business, the company or the owner have the trade license, but not under the company law, not under the company law applicable per VMs. So this is the point where we call such business operator as a unincorporated business. Let's move to the next point that we will understand over here. So what is the first form of the unincorporated business? That is the sole establishment. This is what I am discussing, the sole establishment. This is the most of the common form, and most of us, we are seeing the sole establishment. Second is the partnership. Now, mostly during this initial registration phase of the corporate tax, we are receiving the many queries from the clients as well as from our same fellows who are working in the market as a consultant and the other in other groups of the corporatex. There are many groups of most of the self-initiative. They made the groups. So they are raising the query, what is the sole establishment? And sole establishment that people normally assume this is only one person owned by a company, but where the two-person are coming, there are the two partners are coming under the same format, they think under which category they will fall. And most of them people take this partnership also under a juridical person. This is the common misunderstanding, and this is the mostly in this SME sector, because most of people are not well aware about the company law. So there is a many mistake is done. Initially, the FTA approved, but later on, FTA come to notice and they start rejecting that also, and they are redirecting to the correct registration. Now here the first difference that we gonna understand. Under the unincorporated business, maybe sole establishment, maybe partnership. Both are the same category. Salaries and wages of the owners 100% disallowed. If the person from his own business is taking the salaries, wages, allowance in terms of education, in terms of transport, or what format he will take these benefits, this is 100% disallowed. 100% disallowed. When we say that disallowed, you cannot deduct from the taxable income. There is a difference between taxable income and the accounting income. Mostly we, as of today, before the corporate tax, we are doing the accounting income. The profit and loss we are preparing based on the accounting income, not based on the taxable income. So there is a difference. Because what is the difference? Because in taxable income, this expense you can deduct, but in the taxable income, to some calculate the tax liability, you cannot deduct. So even whatever the amount of the salaries and wages under the unincorporated business, you add it into the business, that will be not deductible. So here the point we are discussing the business income. So hope on this point is very much clear for you guys. Let's move to the now. Okay, now we already understand the non-deductible from the income as just the same non-deductible from the taxable income as expense. Under accounting you can deduct, but under taxable income you cannot deduct. If you already deduct from the accounting income, while calculating from the taxable income, you have to add back. So now who will pay the tax? Who will pay the corporate tax? Okay, in the whole discussion, we will maybe use the word tax or the corporate tax, but there is no income tax. Just for our understanding, even the natural person is paying or the unincorporated business paying, they will pay the corporate tax only, not the income tax. The business, such business are the transparent, because in LLC, the LLC is a legal person, so that is a standalone company in the eyes of the law. But in the sole establishment, the business, under whatever the name they are operating, it will be transparent, because the business do not pay the tax. Who will pay? Partners are the sole proprietor of that business. They will pay tax. They will pay tax, and while calculating the, and they will pay. Here is another important part, because if the one natural person having the 5 sole establishments are having the 3 sole establishment and 2 partnership in the sole establishment with another company, so they have to calculate their under their name by calculating the income from the 5 establishment and taking their, if they are part of any partnership, they have to take the relevant share and they have to prepare the taxable income. The first part, they will take the accounting profit all from all the establishment. Then they will I will use the word consolidate for our better understanding, because most of our working in the profession, we understand this all consolidate. I'm trying to explain here that if one natural person have the 5 sole establishment, so he have to consolidate the revenue and expenses of all this whole establishment and make as a consolidated income and the expenses for the taxable purpose. So even from all the business, salaries and wages will disallowed. And if he's a part of any partnership, he have to take, if he's a 50% partner in any partnership, so he have to take the relevant share, that is a 50% from that business, and consolidate into one. Here the business will not pay the tax. Here the partners are the sole proprietor, they will pay the tax. As earlier I mentioned, UAE, we do not have the income tax, we have the corporate tax. So the individual who's running the business via trade license are required to take trade license located in some engage in some activity or running any business in the UAE. So they have to pay the corporate tax on that. Even the activities you are doing that required to have the trade license, just in the previous example, we understand they are subject to corporate tax. Now the second category or the second type or the second vehicle that we are going to discuss, that is the incorporated business. When we say the incorporated business, so again the same point that we discussed over there, salaries and wages, that is a disallowed, and here will be allowed, but still some terms and conditions are there. What are the terms and conditions that we will have to understand? Even during the last session, we seen the some of the question. How about the salaries and wages in the businesses? And unincorporated business we discussed is disallowed, but in incorporated business, juridical person is allowed. But here the still arm length. What is the arm length? For the employees, 100% will be deductible. But for the owners, shareholder, directors, or their family members, the word connected person is important. Because if the owner or the CFO of the company or shareholder of the company or the director of the company, they are all the connected person. This is just understanding purpose, but we will discuss in detail what are the connected person, because connected person but blood relation, it will go 4th degree. 4th degree up, 4th degree down, 4th degree left, 4th degree right. Because the circle they draw up to 4th degree. We will discuss in detail what are the connected person. So they are saying if shareholder, he make the employee his wife, his kids, his another relative in the company, and he just want to pay them higher salaries, so and reduce the tax base. To reduce the tax base, they will engage, even they are not working, and even they are just part of the their family member, but to reduce the tax base, they will put on the payroll. So FTA is saying if while doing the FTA audit, so they will ask this detail, and they think such you can engage them, but you will pay all this benefit on at the arm length. What is the arm length? Arm length means if in the market other companies paying this salaries to their CFO or their manager or their HR manager in whatever the format. So you are engaging your connected person in that position. So we have to see what are the market standard. Now the market standard, there is no definite rule. We have to consider, okay, what is the company revenues, like revenue, according to revenue, how much they can afford, and according to capability, according to skill set of the person. So they will consider a lot of factors. They will do their own exercise, and then they will give their comment on that. And if you are exceeding, they may charge penalty, or they will just say if the minor difference, they will give you some comment and move forward. But try to reconsider this, do the exercise, and how it will be important for the corporate tax return preparation and submission. Mostly we are receiving the comment, okay, but we can increase their salary, our shareholders, their family members who are working, we will manage that. No, this is not blindly you can increase. You have to make the market analysis and remain in the arm length. So what are the incorporated business? There is a private companies, private limited companies, limited liability companies, public joint stock companies, incorporated companies, LLP. See, this part is the most important for our understanding. This part is limited liability partnership. Here is the partnership. Because the partnership, there is a no contract or the verbal contract. If you establish the partnership based on the verbal contract, you can do that. This is not required, or you may make the contract and notarize just for your own record, in which you put some, the profit distribution, working distribution, your working arrangement. But here, if you limited liability partnership, if you limit the liability of the partners by putting some capital, and you say, okay, the liability of the partners is limited, then that partnership business will fall under the incorporated business. Single person companies, here saying sole establishment, but under unincorporated business. But here saying single person company, sole proprietor. But this company, the word LLC will be there. Another point for a common understanding, memorandum of association will be there for such companies wherever the memorandum of association, because that for your understanding, company will be registered as per company law. Please go when tomorrow when you go to office, see your company trade license. What is the legal type? What is the legal type? So mostly that legal type will give you the understanding. Plus, you have to see, okay, this company have the memorandum of association or no. Let's move to the next point. Now here the business will pay the tax. Here the owner will pay the tax. Under unincorporated business, what we are saying, the partners are the owner of the company, they will pay. Business will not pay. Here we are saying business will pay the tax. The business will pay tax. Now here the transfer pricing rule will be applicable. Transfer pricing rule, why? Because maybe the same owner, he have multiple companies. Maybe UE, inside UE, outside UE. So again, they might transfer the higher company profit to another company outside country. So where the jurisdiction is a lower tax, or they are doing how they do, they will do the transaction through the price adjusting, and whatever the means, we will discuss in detail the transfer pricing concept, how it will work. So what are the transfer pricing method, and how you can review on that, and how you will prepare the master file and local file. But here the way understanding the overall concept. So transfer pricing, when you are part of the group of the same ownership, same ownership in terms of even the corporated or even the shareholding. So we have to review the transfer pricing rule also. Okay, now here we discuss again, I'm just adding the points for the information note. What are the information note? Information note, if you have the local dividend, that will be exempt. Because from the local dividend you receive from another company, that company already paid, and then you receive the dividend. So you will not deduct as a expense from your income, or you will not add as part of your income, because the party who give you dividend is already deducted and paid the tax. Now here, just for understanding, we are putting the non-deductible, we might say as a haram income or haram expenses. In Arabic language, the word mostly we are using. On the other side, if it's allowed, we can say the halal expenses or halal income. Here, the another part I just because such information we added to enhance the vision, to for our better understanding, to improve the understanding. As of today, we are building our understanding towards the corporate tax. In the UK, the companies are they are prepared. In UK, even the natural person, they are paying the income tax. even they are running the business under the same format what we are discussing as the unincorporated business, they are paying the income tax. Why we added this example? To have the better understanding. They are paying the income tax, but in UAE, we will pay the corporate tax. Why? Because they think in UAE, we do not have the income tax. So here the FTA, Ministry of Finance, they said the business activities, the more juridical person or business activities, if you earn the income from the business, then you have to pay the corporate tax. We will not pay the income tax, but in UK or the other jurisdiction, the natural person, they are paying the income tax. In UAE, there is no income tax, but currently in Oman, they are already applied or about to apply, implement the income tax also. In all the Gulf countries, I believe this Oman is the first GCC country who is applying the income tax, but they are not applying on all the person. They are applying on the high income, high salary people, or the person whose income is a high level. So they have some threshold. They are applying on that. Here in UK, the income tax on the personnel or the natural person is a 45%. If there is a different threshold, if you exceed, it will be go to 45%. But in companies, the corporate tax is a 9%. So of course, the people mostly will make their companies to adjust the corporate tax liability within the means of the applicable rules and regulation. So this is the one of the understanding and one of the reference I'm sharing here. In UK, they've established the L.L.C companies instead of operating under their name. If mostly we are professional, we have the relative friends in the Europe or other part of the world, so they are mostly establishing the companies to run their business because they will have the many benefits over there. Let's move to the next. Yes, I think the slide is great. Now here we are discussing the partnership. So now, so let's understand the partnership one flow the same way we discussed already, but for our better understanding, we are going to discuss this. The partnership in UAE, Corporate Tax Article 16. You can go on Google and search the partnership or the Article 16 of the company law, and you can read that. Okay, now you may see here I'm giving you the overview for understanding, but if you go and read the article, then your reading and the understanding of the legislation will be improved. The partnership business, normally, what is the partnership business? If we familiar with the joint venture, where the two people or the two companies, they can make the partnership and they run the business. So IFRS 11 is on the joint venture, is mostly on the same pattern. In the professionally, we read the IFRS 11. If you read and then apply over here, you will have the better understanding because there is no venture word used in the corporate tax in this regard. But as a profession, we know this. If we apply the more likely or more closely, how it will be work and how it will be applied. So just go through the IFRS 11. In the corporate tax training, we will our keen focus or the key area is the corporate tax, not the IFRS, but we will highlight some common point where resemblance are there that will help to understand, but we are not going to in detailed discussion of the IFRS. There will be some impact from the IFRS because the corporate tax started after you have the audited financial statement. It's not audited financial statement, but we can say the prepared financial statement as per the applicable IFRS. So now the partnership business that can we separate into two: local partnership, like local business or local natural person, they make the partnership. The second we can discuss in the foreign partnership. So Now let's see the local partnership. The local partnership, unincorporated partnership, and versus the incorporated partnership. This flow will give you the understanding. Earlier we already discussed this. The unincorporated partnership, how will be unincorporated partnership? Unincorporated partnership established by agreement, written, oral, and here is the most important part. This is not a separate legal entity. In the juridical person, L.L.C company, that is separate juridical person, because limited liability, by law you are the limited liability, but here is no limited liability. So this is not a separate legal entity and is transparent. When the transparent means whatever the income or whatever the expenses or whatever the claim or whatever the liability coming on that business, it go directly to the owner. Versus in limited liability, it will not go to the owner, because that limited liability itself is defining this business is established based on the uh, some legal some applicable rules and regulation based on the law of land where you are operating. Okay, now we seen the unincorporated partnership can be established based on agreement that can be written or verbal or oral. In terms of the contract or the agreement, that in law you may go to understand our written or oral also is the agreement in the eyes of law. But oral is normally is difficult to give the evidence or proof in case of dispute, but written it will be much prominent and for better understanding as a in future in case of dispute between the partners. So the written agreement they still can use, but that written agreement will not make the limited liability. This is just the way of operation or how they will operate that under that partnership. Okay, now here we will see the partnership. Here we are saying the partnership will not pay the tax. Who will pay? We already seen the partnership business will not pay the corporate tax by its own. The individual partner will pay corporate tax based on their shares. If the sole establishment only one owner, he will pay the corporate tax. If more than one, so that is fall under the partnership. If you take the same concept of the sole establishment, where is the one owner, and if there is a two owner, that is a partnership, and they will pay based on their shares. But here we have to adjust the wages and salaries, that is not deductible. So unincorporated partnership, the percentage of asset and liability and income, we will prepare their accounting statement and based on that we'll proceed, and the salaries and wages we cannot deduct from here. The next point, here even this partnership business, they can apply to FTA instead of tax on our on the shares on the shareholders or the owner. Submit the application, treat this business as a taxable person for the corporate tax purpose. They can submit, the word is used, the OPAC. They can apply to the FTA. First, they have to register, then they have to apply to the FTA. If FTA approve this, then partnership will pay the corporate tax. No more transparent. No more transparent. This is the important part. The one important part from the corporate tax return I will highlight to you. Under the partnership, it will be relevant. And the next slide I'll show you. If partnership approved, so business will pay tax. Is not anymore transparent. The word transparent means whatever the liability on business, same liability of the partners or the owners or the natural person. This is the word of transparent. Now, if an FTA did not approve, then individual partner will pay the tax, corporate tax. Okay, now here the next second leg of the local partnership that we are discussing, the incorporated partnership. Here we are checking whether the partner is a limited liability, like they already have the agreement where they make the liability of the partnership is a limited based on the applicable regulation. So we have to check this, because even the partnership can fall under juridical person, but this is the criteria to evaluate. So no limited liability. If there is no limited liability, same as unincorporated partnership, the same above we discussed the concept. So the owner or individual will pay the tax. It will be on the shoulders of the individual or individual partners. But if this is the limited liability, so juridical person, if the limited liability, that will fall under juridical person. The partnership will pay the tax, corporate tax. Now we going see the foreign partnership. The foreign partnership, so set up in the foreign countries as per the foreign laws. So we here the foreign partnership, they might operate in the UAE, or the foreign companies already operating in the outside the UAE, and they want to establish the business in UAE also on the same pattern of the foreign partnership. Here the important part we have to check whether the partnership business is subject to tax in the foreign country, because the company already registered in the foreign jurisdiction, they are paying the tax or no. If it's a yes, here's the yes, consider is as a juridical person. Because now we have to consider, because when we talk about the international, so the double tax treaty agreement will be part of that. So now, and that also we have to consider on that. But here we are just considering if they are paying the corporate tax in the foreign country, here will be juridical person. If the partner are subject to tax on their share of profit, no, the same. They consider as the unincorporated partnership, partner will pay the tax. Consider as it is a transparent. Let's move to the next part. Unincorporated partnership, as I already mentioned, this is the return, corporate tax return. I took this question or this point from the corporate tax return. The corporate tax return mostly, maybe I expect the people already seen, but even you're not seen, you might go to the ProTax e-learning online, and I already uploaded the one demo video over there in which you understand what are the step is part of the corporate tax return. That also important. You might seen from your company corporate tax return template, or maybe from the FT also uploaded the return template, or you can go over there on the ProTax e-learning and you can go through. And I raised the question I took the question from the return and added over there for better understanding, and I shared the video on the YouTube. So let's understand this part. So this is the, while filing the first return, they will ask this question: is the taxable person a partner in unincorporated partnership? If you say no, it will move forward. What if the person is already, even the natural person as a sole establishment or partnership, or even the juridical person, they might have the joint venture with another juridical person. So they also fall under unincorporated business. So if you're saying the yes, so the here you have to put the TRN. This is the point I want to share with you guys. If you say you are part of unincorporated business as part of natural person or as part of the juridical person, they have the joint venture with another business, but that is not the limited liability company. Mostly we call the JV. Many multinational company, they have the joint venture, normally we call the JV in the UAE, to operate on project base, on the product base, or many possibilities that if we talk about the business vehicle. So again, the concept, what is the objective and which vehicle they will use. So one of the vehicle they will use the unincorporated partnership, they will make the joint venture. So then that here in your return, as your company or you are part of another unincorporated partnership, so you have to add the TRN, because when you pay the tax on that income, and you have to disclose during in this return also, because that will be not subject to taxable under this return, because you are part, you already submitted that taxation. Here you will give me the just the information. Okay, this is the, you are part of the unincorporated partnership, but parallel, they will ask you further information in the second part of the return. So hope this point is clear. Here I added some points for better understanding, but we already discussed all these points. If you guys want to read, so please take few minutes and read this point. Let's move to the next point because this is all the point that we already discussed. Early in previous slide, we are mentioning when you put the unincorporated partnership TRN, because you are part of that, so he will ask you further, because based on that, this tab will be open and return. If there you mention the no, so this questionnaire will not be open. If you mention yes, you added the TRN, then you have to, this field will be activated, and this field activated where? Under the return section 4. So the reading is like that. If we say the yes, this section 4 accounting adjustment and the exempt income will be added over there. Now this is the question. The corporate tax, if they derive the accounting profit from the unincorporated partnership that are treated as a separate taxable person, you have to fill up this question also. Give the information. So why I'm linking the relevant, because I will try my level best to add the relevant tax, corporate tax return, the relevant questionnaire on the relevant section or the relevant area that you able to integrate with the corporate tax return. Our primary objective to go through the tax series, enable ourselves or skill ourselves to understand the corporate tax return, prepare our books of account as per the corporate tax return, and to file the return. So inshallah, by continuing this tax series, you able to do all this activity. So if we mention over here is no, so no further implication. But if we selected the mention yes, so then further section of that will be open. What are the further section? As we mentioned, we will discussing these points in detail when we are discussing the unincorporated partnership. Yes, we will understand and we will make some example to refine our understanding in this regard. So based on our shareholding, if we already mentioned yes, we have to fill up all this information. Accounting net profit derived from the partnership that treated as a separate juridical person. If you guys notice here the net profit, they are interested to ask, they are keen to take the information. During the first return, there is a transition period also. You have to give them the opening balance also. What is the opening balance? If you're gonna file the return for 2024, so they will ask the opening balance of 2024 also, because you will give the closing balance of 2024, but the opening balance of 2024 also you have to put. That will be for better understanding the closing balance of last year, last tax accounting period, that is 2023. Because such balances, they might have some impact that future will be, you will reclaim or you will put them in front of in return. So then FTA will recall and say, okay, earlier information you disclosed to us this, so we will treat according to this. If any information is changed, so they will ask for the documentation, or accordingly they will do the needful. Here the important part, we have to in our accounting system, So we have to make the separate line item or the chart of account where we understand. Because if you make the unincorporated partnership only, if you have multiple unincorporated businesses, if you make only the one account and you keep putting profit and loss, it will give you net off. But if you make the two chart of account line item, then it will give you the one for the net profit, another is the net losses. This is your convenience. You might make the two line item, and that system will give you the understanding while from the accounting system, and it will be just easy to fill the corporate tax return. Or the other way, you can download in the same ledger and split into and identify how much the losses and profit. But FTA is very keen on the different area of the return. Wherever you say the loss and the unrealized loss and unrealized exchange loss, also they will ask the unrealized profit, unrealized losses also. They will not take the net figure. They will take the breakup also. Here, the another next point, the gain on the transfer or sale or the other disposal of interest in the unincorporated partnership. Now we are familiar with the capital gain or capital loss. This is the income part. This is the capital gain. Currently, there is a whatever the income is coming, that will be treated under the same as the income tax. There is no separate capital gain or tax that normally in other jurisdiction that normally as part of the ACCA, as part of ICAW, we know the UK taxation is much better. As part of study, I believe most of the people, they go through that taxation, so they understand what is the corporate tax. Or even the other part of the world we belong, maybe India, Pakistan, or the another European country, they also have the similar concept. Then the percentage of the taxation may differ, but the basic concept will remain same. The UE corporate tax, they're taken from the Netherlands taxation, the main theme, the main structure, but on top of that, they made some changes or modification to refine that. Hope this point is importance of the unincorporated business in the return is understandable for you guys. Let's move to the next part. Now we're going to discuss the part number 7. So what is the part number 7? Today, earlier we discussed the part number 6, our second day. Now we are second day, we are discussing the part number 7. So what is the part number 7? Revenue recognition or revenue condition. What is the importance of the revenue condition? If we're saying the revenue condition, commonly we say, okay, how much the revenue you have. Based on you have 1 million, 10 million, 100 million, 50 million. So based on that, certain regulation from the accounting standard and certain regulation from the applicable IFRS or certain regulation from the tax regulation have the impact on that. While preparing the tax return, such regulation will make the impact, and you have to know that. And we have to know that and understand what are the impact and why this is important. So why we gonna discuss the revenue condition, because this again as a part of the our comprehensive understanding today. Let's move to this topic. Here I added again from the return, from the corporate tax return, this section is added because the revenue condition, some selection is applicable and some condition are applicable. And what are that? So one of the revenue accounting policy and selection based on the revenue. So what are the accounting policy normally we aware? We use the cash basis accounting or accrual basis accounting. So we have to notify to FTA which accounting policy we are opting. And this option is available to all businesses. The important part, this is available to all the businesses or not. So we will learn to which business or the which revenue criteria is available. And if it's available, if which way is beneficial, they can choose a accrual basis or they can go for cash basis. So this is the understanding or analysis as a part of the team, accounting team. We have to do the analysis and understand which will be beneficial based on the subject business operation. You might give the advice to the employer, to the company, to the client, or any format that you are working in the field. So let's see from this question, or this selection is coming from the tax return and it will be appear in the same way. I try to make in the same fashion the question style design. I took the data and I from the FTA publication, and I'm just trying as a part of the presentation, as a part of the training, as a part of tax training, I'm trying to give you the insight of the tax return as well. Here, based on the revenue condition, we can take on the which basis we are preparing, cash basis or accrual basis. This is the option given by FTA, the Federal Tax Authority, as per the corporate tax law. The second, we have to evaluate, analyze, is this beneficial for us or no? This is the internal analysis you have to see. First, you will aware whether law is permit for that or no. If law is permit, now you have the option to analyze. So here, during the tax period, the tax period word is the accounting period for juridical person. We already learned that normally the corporate tax law, they will mention the tax period. We are saying the accounting period and tax period is same. There is no difference on that, except the natural person, that is the Gregorian calendar year. So their Gregorian calendar will be their tax period. So which industry, just for example, for understanding, I added here. So which industry normally use the cash basis accounting are suitable for them? Maybe small shop, restaurant, supermarket, bakalas. We very much commonly familiar with bakala. Not only small supermarket, because the supermarket, big supermarket also there, like the Carrefour, like Lulu, and there is a big names that they are the big mall in the UAE, but we are talking about the small supermarket. So such business are use item. The mostly some industries are working in the use item like this. In UAE, there is a used car is a good market in the Sharjah. Very big industry in the Sharjah industrial area. Sharjah is available, and Dubai also there, but in Sharjah is the biggest market. Mostly people are familiar with this industry or any other used market, so they are not only beneficial to having the cash accounting. They opt to use the cash accounting because they do not have much accounting team or the professional on board, but their business also support to them. Now here the revenue condition, but they're saying if the revenue is less than 3 million, the important part we have to understand, if the revenue of such businesses, if revenue of such businesses is less than 3 million, if less than 3 million, yes, then this is the option for those businesses. If revenue is exceeding 3 million, then you do not have the option for the cash basis. You have to opt for only for the accrual basis. Now, the first option you can choose for the cash basis, or the second option you can choose for the accrual basis. And here we are discussing they might not have the appropriate accounting team, but here the accrual basis, because the cost of accrual based accounting will be more. The administrative cost will be increased. In a cash basis, the administrative admin cost will not be increased. So the accrual base, you have to select the prepare the books of accounts and keeping the record of the accounts in the appropriate way. Mostly people are using the accounting softwares. If we talk about the big multinational company, they're having the big ERPs like SAP, Oracle, or the another application. But that's normally the small business owners or the small clients, they do not have the budget to have this such big system. So normally they use a small application. Commonly we use the QuickBooks, Zoho, and now in the mid-market size, the Odoo is much of the good example that is in UAE they are grabbing the market. So that Odoo is we can say in the ERP model, but is comprehensive because the Zoho and the QuickBook and the other application, they are only the accounting tool basic, but the Odoo is a ERP model, and this is they having the more share upcoming in the UAE as well. Although this is Germany based, I believe, if I'm not wrong. So they have a good share in the Europe, but now it's capturing in the UAE also. They added the localization also, the localization where the local rules are inbuilt, like the VAT and the corporate tax, the rules are built. So maybe people are familiar about that. Other businesses also are there. Let's move to the next slide and understand. See, this training is practically is the good understanding for the professional who already in the UAE, and also as well as the opportunity for the new professional who's coming from the home country and the part of job seeker in UAE. So they can also take the advantage and they can increase their job opportunities or the selection of in the interviewer eyes. It will enhance their percentage or chances for the getting selected. So now we will see the accounting standards. What are the accounting standards in UAE and why we gonna use that, and what are the revenue condition for that? So the first accounting standard, we're gonna understand we have to determine the taxable income under the corporate tax law by applying the applicable IFRS. So here now we've seen if less than 3 million, you can opt the cash basis. If above 3 million, you cannot opt the cash basis accounting. Now the another point we are saying exception generate under revenue. Here the accounting standard, because as a part of the accounting standard, mostly we are familiar the full IFRS and the small SME IFRS. The full IFRS, the cost of implementing the full IFRS is more. Admin cost will be increased because you have to see all the compliance and what is the just for understanding why we are saying the SME IFRS cost is maybe the lesser and the full IFRS cost is more. Because then if you go for the full IFRS, if you go do any revaluation or any part of the, like commonly we understand the actuarial services or the property valuation or any other, that you have to take from the approved or certified valuator. So then you have to take board on the professional from that industry, take the certification from that. That is a third party service, that is the additional cost. Then you will add into your financial statement. But if your revenue is less than 50 million EET, if revenue is less than, so you have the option, you can go for SME. But still, it's not mandatory you go for SME, but this is the option is available. You can opt for the SME and you can prepare the financial statement based on that. Here, the other earlier I mentioned the third party, the application or the evaluator, that is not mandatory. That is because in SME there is many relaxation are there. So here the what is the SME and what are the full IFRS in the UE? Just for our understanding, mostly we are dealing with the banks as a personal matter, personal credit card or personal financing or any format of that. So when we go to the bank, they will say, okay, your company is not registered with us because your company employees is less than them. So they have their own categorization. They are saying if you are exceeding the part of the 50 employee, you are part of the SME. But if you are from 100 to 250, then you are more than 250 employees, you are part of the big entities. So these definitions based on the financial institution or the other they have their own reference. This is not from the IFRS. This is not have, because as per IFRS, there is no such guideline. As per IFRS, if the listed company, what is the listed company, that normally the company whose shares are traded in the listed stock exchange, they are listed company. Recently, if we familiar in UAE, the DIVA, the way electricity authority, they listed, I think 1 year before, the part of the they launched their IPO. Earlier it was the state owned, and now is the public listed company. So now the Diva market, they are launching a lot of new substations, also projects also, to facilitate the new development in the UAE also. So this is, I just share this understanding to have the better understanding. But here in the taxation point of view, if the turnover is less than 50 million, yes, you can go for SME, IFRS SME, and there is no mandatory requirement for the audit also. If your company revenue is less than 50 million, there is no mandatory requirement for the audit also. But still, as you are preparing the IFRS compliant financial statement, then you're able to proceed with the return. So then, if practically we're saying, so maybe this is required. This is required to understand how the things will be moved forward. As long as you are preparing the financial statement, and mostly small company, they do not have in-house team. If they do not have in-house team, for sure they will take the external services. Yes, in the market there are many consultants also available who support the preparation of financial statement as per applicable rules and regulation also. Let's move to the next. Here the important learning we seen that less than 50 million we can opt for the SME, and the less than 15 million for the mainland companies. Again, the important part, the mainland companies, audit requirement is not mandatory, but as part of the free zone, the mostly free zone itself, they by default they have the requirement from the free zone authority. You have to submit the audited financial statement every year. So now this is their regulation. So corporate tax, as earlier also I mentioned in first session, the corporate tax, they consider the existing regulation. While considering the existing regulation, they did not make changes. They align their regulation as part of the existing regulation. So as free zone is saying, audit report is mandatory to, as per the FTA, the corporate tax law, the return audit report is mandatory for free zone as well. Even the whatever the revenue for the free zone audit report is mandatory. Let's move to the next point. We will discuss in detail. The free zone is another comprehensive topic and the very interesting topic. Mostly the industries or people are working in free zone. They might get in touch with me. I can give you insight on any specific topic also, any specific issue they are facing. What is the applicable requirement in that specific scenario. But inshallah, we'll have the detailed discussion in that session also. Taxable person shall follow accrual base of accounting when preparing the financial statement. This is already we discussed. An exception taxable person may follow the cash basis when preparing the financial statement, but if the revenue is less than 3 million. Election for realization base is also available. Election topic we will discuss in detail. Here's another point I just want to highlight. If you opt for the cash basis accounting, and your because now you have the option and your revenue is less than 3 million, but next year is increases that more than 3 million, you have to notify to the FTA and go for the accrual basis. And it is vice versa also. If you having less than 3 million, but you offer the accrual basis, you may apply to the FTA and give the circumstances and whatever the explanation, and you might come back to the cash basis, but subject to the appropriate clarification that you provide to FDA and subject to approval based on the applicable condition. Now our interesting topic, that is the taxable income. The taxable income. So we're gonna discuss the taxable income, but before discussing that, we are just now discussing the IFRS for SME, the financial statement. So what is the financial statement? How many components in financial statement? This is the important part. We will understand the financial statement, the audit report, normally in which the financial statement are there. The 5 components what we are seen in the financial statement, the income statement, balance sheets, cash flow, equity, notes to account. This is commonly we are familiar. But actually the financial statement components are 6. But commonly we've seen 5, but because IFRS allow us to make 5 or the 6, but practically is a 6 statement. So what is the 6? Because income statement, they have the other comprehensive income. Other comprehensive income, IFRS allowed to be part of the comprehensive income or the prepare the separate other comprehensive income. This is the important part for our understanding that have the impact while preparing the taxable income. Because normally the taxable income preparation, we have to do some certain adjustment. But that this important concept will help us while doing the adjustment. We will go through this important part and during our session. Here I'm highlighting why, and we will see some example also where is shown the other comprehensive income and what are the impact. So taxable income, normally we are familiar the taxable income if on business is earning the income, they have the associated expenses that is purely for business. There is no private element that is the deductible. If there is some private element, then there is the applicable tax guideline or tax regulation. We have to follow that and do the adjustment. Normally, we prepare our financial statement as per applicable IFRS that we already seen. Once we prepared our financial statement, so after that, now here, as part of this training or as part of our understanding, we have to understand one important part. We are discussing as a tax accountant or tax professional. At the same time, our responsibility will not be the preparation of financial statement. Preparation of financial statement is part of the financial team or the accounting team. They are working on that. So we have to, even while giving advice to the client or while negotiating with our clients, we have to explain this part also. If you need this service for the taxation, this our responsibility, our scope of work is the start from the taxable income. But you have to give us the financial statement that is prepared as per applicable IFRS. But mostly the issue or the reason of the financial statement, maybe mostly people are not following the applicable IFRS. So that may not be appropriate. The tax professional or tax accountant may end up with the wrong return submission because the previous data that come from this area is not compliant as per IFRS. So this is also important, and we have to notify if we are working as a tax professional or a consultant or even the accounting team. We have our keen area. This also need to be improved, need to be refined as per applicable standard also. If this is appropriate or if this is done as accurately, then that tax accountant or tax professional job will be started. So now tax accountant or tax professional take this IFRS prepared financial statement and he will take this data, accounting profit before tax, and from this IFRS prepared financial statement, he take from here and he will start making the adjustment. Adjustment, because some expenses that have the private element, the tax law is saying is not deductible. Tax law is saying is not deductible, but in accounting team, as per accounting, is already deducted. You can make the adjustment considering that. And some income they already deducted, but tax law is saying no, you have to add back. So we have to understand this adjustment in detail. This is the preparation of the tax return or the taxable income. We are starting from the accounting profit before tax. This is the important part where we are earlier seeing the other comprehensive income. We are not starting our tax calculation from the other comprehensive income or TCI, total comprehensive income. The word TCI, total comprehensive income, we are taking from the accounting profit before tax. Let's move to the next. Accounting profit calculation. Accounting profit calculation as per the accounting standard IFRS, because the accounting team, they have to prepare the financial statement as per the applicable IFRS. Then the data or the transaction will, the financial statement will hand over to the tax professional or tax accountant team or the tax department. Here we have to understand we are trying to learn the taxation also, but it's not important. The same time you work as a part of accounting team or same time is the taxation team. Maybe people are working under tax department and they are not working under the accounting team, but still they need to know the IFRS. Why? Because if they know the IFRS, so they can differentiate, okay, this adjustment is not there. They can analyze the financial statement better than the person who not background from the accounting team. Because in the tax profession, the many people, they are from the legal background as well, or any other background as well, because they are the tax people. They don't have to know the accounting. They have to know the law and apply on the accounting data. But they might do mistake. They might end up with the mistake because that is not their mistake because the financial data is inappropriate. So they cannot identify your financial statement is not appropriate. They will prepare the tax return as per the provided data, and they done their job, but the ending up with the error or the low taxable income or excess taxable income or the tax optimization strategy. What we can say, they may not give you the tax optimization strategy versus the person who knows the IFRS. And the IFRS, normally the ACCA, ICAW, or the CPA, or any other professional body, they commonly knows. Here's another part, the gap. Gap is not in UAE. Gap is not UAE. Here they recommended in the city law and the FTA publication, the IFRS. So keep in mind, our financial statement will be in IFRS. Even the multinational company who are preparing their financial statement to be part of a group, but they have to prepare the local financial statement as part of the applicable IFRS. So IAS, the mostly accounting standard, the previously is used commonly. Now they are converting IAS accounting standard to IFRS. Practically both are same. But we can say the IFR is the latest version. All the previous IAS will be converted to IFRS. As of now, there's a difference. Total is 41 accounting standard. But from the 41, only active or live is 24. Other is obsolete or they deactivated or based on the latest study or the evaluation, they make them obsolete. So active IFR is only 24 out of 41. And from the whatever the obsolete, the word we use, they are converted into the IFRS. Okay. So as of today, is the 17 already is there, because whatever the obsolete they converted to IFRS, 17 is there, or 18 because there is the IS1 that also converting to the IFRS also. IS1 will be converted to IS18. Mostly the publication already there for the same. And we mentioned the new IFRS replacing the IS1. This we will see a couple of the standard as a IAS that previously part of IAS now is part of IFRS. IS 17 converted to IFRS 16, IS 18 revenue converted to IFRS 15, IS 14 segment reporting converted to IFRS 8. Accounting point of view, audited financial statement. Here we discuss the quoted company and unquoted company. Here we, for understanding, we are saying the quoted or listed company, they will follow full IFRS. Apart from that, all other company, as per the IFRS, they can follow the SME IFRS or full IFRS. But the UE tax law, they given some condition. They said less than 50 million. You have the option to follow the SME IFRS. Unquoted company, they can follow the SME IFRS. It is choice for the unquoted company, they can follow full or the SME. But while considering the choice from the IFRS, we have to see what is the local regulation. When we talk about local regulation, corporate tax is a local regulation. So their condition is a 50 million, so we have to follow the local regulation also. Here the Oman and Qatar, they are not allowing IFRS SME. IFRS SME is a short version of the full IFRS. Oman and Qatar, they're not allowing this, but other part of the world, they already allowed this. We left only 10 minutes, so we'll try to close the today's session. Then we'll discuss the question answer session. Let's see the next slide. Now the financial statement here, we sharing the reference ministerial decision 114 of 2023, in which they mention the accounting standard method. Accounting standard method that we are discussing accrual basis or cash basis, and the preparation and maintaining the audited financial statement that we are discussing. If revenue is less than 50 million, so you don't have to prepare the financial statement. But if the revenue is more than 50 million, you have to prepare the audited financial statement. And as a part of the record keeping, we have to keep 7 years from the end of the first tax period, the record for the taxation purpose. And here is the important part or the important understanding I want to highlight. Here when we mention the 7 year from the end of first tax period, so normally we understand the 8 year roughly we can say. But the another important or critical part during the VAT, okay, because FTA, they have the resources, but still the market is a big and the client is big, many taxpayers are there. In terms of VAT, when we are discussing being a professional or consultant together, so we come to know the FTA in sending the audit query, they're raising the audit, because some industries, to control that industry or to be seeing the compliance in that industry, if the tax, let's say if the as part of the VAT is the 5 year, we can revalidate is the record keeping in the 5 year from end of first tax period. So if your tax period is ending and FTA is knowing, okay, they cannot complete the audit of the such industry or such segment or the, because based on revenue or other factor, they are taking the sample. So they are saying, okay, then after couple of months, after 6 months, 8 months, there is no possibility to conduct the audit, to raise the audit query to these companies. So they will raise the audit, although they will not start. Now they raise the ticket for the audit. They will send the notification to that company. So this is the important factor. The law is saying if the already audit tickets or audit query is raised for you, then that year will be continue even you pass the 5 year, because the query is the ticket is raised within 5 year or within the 7 year. So FTA within the law, they come on certain part where they have to do the audit, so they might raise the audit, but it might not start it. If as a part of the professional, many professional, you check with them also, the most of the client they receive the audit query tickets, but as of now audit is not started. But now that year is will remain liable for the under the audit. This is the one of the important part for better understanding. So now here we are saying is audit is mandatory for all entities. We already seen, but just we are refining the same discussion that we already have it in the form of flow chart. Is mandatory for all entities, accounting standard, full IFRS or SME IFRS. Hope you have the idea that what we are discussed. Then the cash basis or accrual basis accounting, for which business is applicable or which business is not applicable. Hope we already discussed this. Here the summarized view. Okay. So here the audited financial statement, we mentioned the Article 54 of the city law and the ministerial decision 82 of 2023. You might go and read that article. You will have the understanding, because now you have overall framework. You can go and go through that article, relevant article. But I appreciate if you spend at least 10 to 15 minutes the article that what we are mentioning, or even mostly we are mentioning the clause also. The ministerial decision article 54. So you don't have to read the full ministerial decision. Just go through, please, the article, because we already mentioned the relevant article of the city law. At least continue that relevant topic that you will understand as part of our the training. You don't have to spend the full time, spend the 20 minutes, 15 minutes and read that relevant article. So here we already seen the revenue greater than 50 million during the tax period. Tax period is accounting period. So this is a mandatory. And a qualifying free zone is a mandatory. Here we mentioned a qualifying free zone person, because maybe some person free zone, again as part of free zone it will remain applicable, but FTA saying if even the free zone company they can opt to the normal taxation, that is 9%, then our requirement will not be mandatory if the revenue threshold is less than 50 million. And as well as if the qualifying free zone person cannot be part of the tax group. If you want to be part of the tax group in the UAE other business, then you have to go for the standard taxation. Here we mentioned audit is mandatory. Our timeline about to finish, but we might take another 5 minutes. I just wish to complete this slide. Basis of accounting, because this slide we already discussed. Basis of accounting, revenue up to 50 million in a tax period, revenue. The basis of accounting period, we go for accrual or cash based on what condition, that revenue condition we are saying. So if our revenue up to 3 million in a tax period, so we can go for accrual. We can go for accrual automatically in return. It will be shown the accrual. But still the option is there. You can opt the cash basis under this if your revenue less than 3 million. If the revenue is more than 3 million, then you have to go for the accrual basis. So here the word is used, the election. Election is required, because in the first return, there is a number of election is required. What is the election? You have to choose one option. You want to go for accrual basis. We seen the return. You tick this box. Or if you go for the cash basis, you tick for that. So why we do that? Because if we opt in the first return, it cannot be changed in the later on, except the third 1 or 2 election that you can change, but other election you cannot change. So be rational and B, do the analysis while opting the election and while doing the first return preparation. Understand the election part is important. Election, you have to choose one, accrual or cash. Here, if you opt for the cash, later on you can give some exceptional circumstances and submit the application to FTA. You can go for the accrual basis also. But the revenue is more than 3 million. We already seen the accrual basis. Only this option we will go. Now, accounting standard, optional. IFRS for SME is an option, but still you can go for full IFRS. If the revenue is less than 50 million, you have the option, you can choose the IFRS SME or the full. If revenue is more than 50 million, then you by default you have to go full IFRS. Mandatory requirement is the revenue is more than 50 million is mandatory, is not optional. We will end up today's session up to this slide, and now we'll see the chat, and if you have the queries for that, we will take the queries. We'll try to answer that whatever the possible. But we appreciate if you have the question from the relevant topic, because we are discussing that relevant topic, that this is the most important for understanding. Now, please, I'm open for the question. Share the question. I'll try to answer on that. There is one question. Arsalan would be tested in the corporate tax or limited one. We just now is discussed in detail IFRS. The condition we just discussed, the condition, if the condition is less than revenue is less than 15 million, it's not mandatory to opt for the IFRS. Sorry, the full IFRS. You can opt for the small IFRS. That we can think the short version of IFRS, but based on the revenue. In terms of tested, see, your return cannot be prepared if your return cannot be accurate. You can prepare, but it cannot be accurate because FTA is saying your accounting treatment as per the applicable IFRS. So first you have to see, and then you accordingly you have to prepare. So next is kindly in the legal person also discuss about the benchmark for the owner benefit. See, here we already discussed in the benchmark. See, in terms of the benchmark, we already discussed the industry norms based on the industry size. There is no hard and fast rule. They from the Federal Tax Authority or the Ministry of Finance, there is a guideline arm length. Now there is no standard benchmark, because the standard benchmark from the industry we have to take. Earlier, I give the example for that because the directors are owner. Even today, I try to explain on that also. If the company turnover is the 100 million, yes, the owner benefit can be comparatively higher. But if the company or the business turnover is 30 million, and you cannot give the same benefit or the salary and wages that you are giving while the company turnover is 100 million. So now the size of that business is get adjusted. So accordingly, you have to adjust that part also. Okay, next, Mr. Iftikhar, I can make you the host for that. Hope you already running the online recording also. Now I'll take another question. Special treatment for GCC based companies. See, there is no special treatment for GCC based companies as of now. But in terms of future, they might give some clarification on the such area. But as of now, there is no things are there. See, in term of the GCC, you seen in, if I give you the example, Saudi, the corporate tax is 20%. So, but in UAE is 9% for the SME, except if we not talk about the MNE. So the double tax agreement will be there based on the double tax treaty or the agreement. You will, if you are paying more than 9%, like let's say the Saudi example, if you're paying the 20%, here you will do just as a part of compliance because you already paid the 20%. On the same compliance, you will pay, okay, 9% is this. Then you will mention, okay, I paid 20%. So that will be higher. Then you will pay zero taxation over here. The similar, if the Saudi, if you, if company operating here, and but they are reporting in the Saudi also. So what they will say, okay, the 9% you already paid as a part of double tax treaty agreement, you will take the benefit for the 9%, but balance 11% you have to pay over there. Okay, so again, okay, Arslan, all the other will be tested or just basic one. See here, IS will be tested or basic one, IS 86. No, here the all the, see, they did not mention the basic one. When we talk about the IFRS, all the standards, only the IFRS SME, the full IFRS will not applicable. And maybe some couple of standard is not fall under IFRS SME also, that we have to see under that, which are the part of the SME IFRS also. From that perspective, we can discuss and understand, okay, these are the applicable, but we cannot count or limit, okay, 15, 16, 70 will be applicable. We are saying the 15, 16 are they are fully not applicable. If you just download, search on Google IFRS SME, you will find that IFRS. You will take that information from there. There is another, it's the Bukhari. Instead of entertainment expenses, if use food allowance, okay. Yes, if it is for employees, is 100% deductible. If it is, but if except employee, if employee is 100% deductible, but if is a corporate or the stakeholders, other stakeholders, owners, vendors, customers, then is it, because that have the private element also, that you will deduct 50% only. For employees, 100% you can deduct the entertainment expenses. If our company revenue is Hamza Tufail, if our company revenue is a 3 million in financial statement, so it is required to do an audit of the no, here I mentioned already, if your revenue is less than 50 million and you are mainland company, here's the two important part that you have to understand. Revenue is less than 50 million and you are mainland company, not a free zone company, there is no mandatory requirement for audit. The Rizwan is there. What if it is sole establishment owned by wife and husband, and if employee is there any restriction on salary? See, in the sole establishment, we already discussed this is the unincorporated business, and we very detailed understand unincorporated business salaries and wages are not detectable from the taxable point of view. 100% will be disallowed. In the sole establishment, the 100% salaries and wages of the owners and the husband and wife, the connected person definition will be still there, is disallowed. Only the employee's salary will be deductible. See, now another part is coming from Shahab Farid. A person with sole establishment, unincorporated business, with the accumulated income is less than what will be city requirement. Okay, now we are saying the 1 million relief for the natural person will be available. So they don't have to go apply for the corporate tax registration. 1 million relief, but you have to be sure that if your revenue calculation is correct, because if you do the mistake, so then you will later on get some penalty also. If you are sure, yes, the cumulative revenue is less than 1 million. The example is less than 1 million. Then you can apply for claim the natural person relief, and there is no corporate tax registration also for that. But if you are not sure, then you can register for the corporate tax and get the SBR relief, small business relief, because less than 3 million, again the relief is there. But in the small business relief and the natural person relief, I will plan one session dedicated only for this. That is, I'm planning end of February, because the mostly people are working on the returns. But in the end of Feb or the first week of March, there will be a dedicated session. There we will learn how to apply for the SBR relief and submit the return also. Then mostly I have humble, we are professional to understand, communicate in English. It will be this other mode of language is okay. That we will see down the line. We will come to that also. We already noted this point. Now there is the natural person threshold for taxable income of 3 million or no. See, natural person threshold is 1 million, not 3 million. 3 million for the to get the benefit of small business relief. Natural person, just now already I'm highlighting the natural person relief. To take the relief, even you go for natural person, apply for corporate tax registration, they will ask what is the revenue. If you mention the 1 million, they will not proceed for the registration also. If the more than 1 million, you have to give the some information, then you will get the registered also. But here the important part, you have to accumulate, consolidate all the income of the natural person. Then you will be able to take the relief. So entertainment, we already answered. Husband, wife, there is a question, legal, but discuss about the benchmarking. The one more point was there. I just want to come. Yeah. Tax consider some are we are issuing benchmarking for related party benefits, especially for director. See, this studies as of now, as I already mentioned, this study we can prepare based on the industry, but mostly this study, if we say the listed company, the data will be available. But as a part of the new tax regime, data is not available. So we have to justify, we have to prepare, first you have to prepare yourself, okay, maybe the directors or the employee or the owner or shareholder, what are the activities he is performing on behalf of the company. So mostly the small companies, they are bringing the business also, because they have the contract, they are will be part of the business. So they are active. So and there's the skills also, if they are qualified and they have the same expertise and the same experience in the same field. So the comparatively this benchmark, if we are discussing the benchmark, yes, such things will give you edge, okay, to justify this much salary is a why we are paying this much salary, because he's a specialist and he have the experience, so he's supporting and business in terms of business, in terms of sales, in terms of technical. So yes, down the line we will have some studies and we'll discuss that also. But as of now, overall framework, each business they have to do based on the size, based on the skills level, their own analysis. But you cannot issue as a benchmark as a consultant. You might give the guideline based on business to business, industry to industry. By reviewing the case, you can share the guideline. I believe most of the kindly and legal person also discuss about the benchmark of the that we already discussed. Okay, guys, thank you very much for your participation. Okay, there is another question. Is there last question for today? Natural person, if our revenue is 1.5 million, net profit is see, if you're a natural person, your revenue is 1.5 million, you can go for the small business relief. because here do not mix with the profit. The profit threshold is a different. That is the tax slab. That is a tax slab. The first taxable profit will be on the 375. In the first session, we discussed the tax rate slab. Please go that and understand that. Thank you. Thank you, Mr. Iskar. You can take care and hope you manage that, the recording part also.